let's talk about your experience on Capitol Hill. I watched the hearing. The questions were, as you would expect of Congress, varied, to say the least here. But I'm curious as to whether you think there's any sort of consensus in Washington now about how to deal with the fallout from this crisis. We know what happened, but the question is, how do we sort of address it?
Yes, I think Congress is still working its way, and Washington is still working its way through it. I think there is a degree of politics to it, which is there's a lot of discussion about changes in the past that may impact what's happening right now. But the reality, and what I tried to do during my testimony, was really focus on the mid-sized banks and also focus on the fact that since Dodd-Frank last changed FDIC insurance 13 years ago, banks have gotten even bigger. They were thought to be too big to fail then, even more so now. That's number one. Number two is the speed of money is faster than I think anyone imagined. For Silicon Valley Bank to have 85% of its deposits withdrawn in a day and a half, that was staggering. So what I talked about and what I proposed was increasing FDIC insurance for businesses and nonprofits for their operating and transaction accounts to try to level the playing field with the bigger banks that are too big to fail.
So would this kind of be like a tiered system then of insurance?
It would, and it's interesting because the FDIC put out a report and they call it just that, which is something that's targeted for a certain area. What I think Congress gets scared of is when proponents say that everything needs to be guaranteed, which I don't think is necessary. I think some very specific changes could make a big difference. Otherwise, what will happen is we'll have a barbell industry with really big banks and really small banks, and I think that will be detrimental to the economy.
I want to get your thoughts, though, just about the size of our banking system here in the U.S. There's been a lot of comparisons to Europe, Asia, and other regions and countries. We by far probably have one of the broadest based banking systems. Some would say that's our strength. But now some people are saying, well, from a regulatory standpoint, it's much easier to manage a few hundred banks versus several thousand.
So when I started my career 36 years ago, there were 14,000 banks in the country. Today, there are 4,700. So already it shrunk. The top 3% of the industry has 77% of the deposits. In terms of the top 3% of the banks, it's already very concentrated. What you get with this, which I think is very good, so those big banks that have 77% of the deposits don't make 77% of the loans to Main Street America. And if this keeps going, the credit availability to Main Street America is going to have to be different. And I think what you'll have is you'll have non-banks making those loans, which would actually, I think, put the economy possibly in a worse spot.
When it comes to those regional banks, those community banks, and we've spoken with a lot of the CEOs of those banks, and they really point out what you just said here, that there are just certain industries, certain types of businesses that would not get lending if it weren't for those types of banks here. But how do you ensure a system that is relatively safe if you do have a community bank that is, say, 80% deposits are tied to the farming industry, or, as in the case of Silicon Valley Bank, to a small cohort of venture capital firms?
Supervision is supposed to do that. And I'll tell you, what's interesting about like Silicon Valley Bank's failure, all the numbers, all the exposure were in plain sight in all the regulatory filings. What no one knew is that it would trigger a bank run. And so I think changes to supervision and some of the limits and more focus on concentration. Silicon Valley, after the fact, we learned, had $13 billion of deposits in their top 10 relationships. That was staggering, something I would not have considered. So I'll bet you we'll see a little bit different disclosure change, but I think, frankly, you can do it through supervision and regulation that's already in place, and we don't need more laws, and we don't need more people.
Well, what about this issue that you brought up here about the speed of which depositors are able to either pull their money or move their money around? That's not going to go away. That's just a product of how our economy has progressed.
As a matter of fact, it's about to get faster.
It's going to get faster.
In July, there's something called FedNow, which is a project that the Federal Reserve has been working on. Think Zelle. I don't know if you know that Zelle.
I remember Zelle.
It's going to be 24/7 real-time payments. So another part of what I talked about is the plumbing of finance. We need the regulatory system, the controls, and the support for weak banks to be 24/7, just like the payment system. They can't close at the end of the day. They're going to have to be 24/7, in my opinion.
But how do you do that without more resources, more people watching?
I personally think it's I think it's technology.
The technology.
Just like the technologies is changing the industry, I think the technology of regulation ought to be able to keep up. Now, that's not my full area of expertise.
Sure, yeah.
But if someone, I think it sounds logical that should be able to happen.
But you understand the banking system better than most. And I am curious that when we work our way through the issues going on with SVB and PacWest and all these other banks here, do you think our banking system will end up stronger as a result of this?
Well, what's interesting is that I hope one thing I come across is I don't want to knock the big banks, because I think that they generally are the best banks in the world.
Right.
Doesn't mean there aren't good banks in Europe and elsewhere.
Sure, absolutely.
But just pound for pound, because there are 27 banks in the world that are designated as globally systemic, and when you look at fundamentals, the American banks are at the top. I think the system is actually overall very good, very sound, and also, you know, there's something called the Patriot Act, which isn't a banking bill, but talks about BSA, anti-money laundering.
Okay.
Those rules are really strict.
Right.
And as someone, especially in New York City, who understands,
and that was the Patriot Act kind of was born out of 9/11,
that came out after 9/11.
Yeah, okay.
Those provisions generally are working.
Okay.
And I give an A+ to the regulators for protecting the payment system in the United States.
Yeah.
It can't be a free-for-all.
Okay.
So I think while it needs to evolve and get better,
right,
I actually think it's pretty good.
You're also probably aware that there's this whole, I mean, if you want to use the term shadow banking, but there's this whole sort of cohort of lenders and other sort of financial companies that are outside the purview of the traditional regulatory structure. And they have become, let's just call them dominant players to a certain extent in certain pockets of this market. How do you address that? Are we able to sort of continue that relationship, or do we need to sort of rethink?
So first of all, I think that there are elements of it that have been fantastic. They provide credit. For example, in certain areas, the regulators have cut down on how much leverage a bank can lend against. And so some of the highly leveraged transactions now are outside the system. That's why we're not as worried about the banking system today as we would have been 20 years ago. However, you know, when you think about what happened in crypto, some of those companies that went bankrupt, they were doing things that were not allowed inside a bank or a regulated securities firm.
Right.
So we've already seen it at work in the market. I believe the regulatory barriers are going to widen, and they probably should, and I think the economy would be more steady and consistently growing if it had that, and I think it's coming.
And when it comes to, though, Dodd-Frank, I mean, a big part of at least the goal behind that was this idea of trying to minimizing systemic risk. And you mentioned crypto. We had that big collapse. It was not systemic, at least that we know of. Even with the regional banking crisis now, some would argue that this isn't a systemic event. Does this sort of disparity in our banking and our financial system, I should say overall, does that end up almost sort of shielding us from some of these contagion effects?
Well, I think, you know, the Fed as our central bank, as the lender of last resort, is quite powerful in terms of supporting the banking system. They have lots of tools that they can use. But, you know, what I find is remarkable is that these losses that have happened have not seemed to be, like you said, systemic. But I don't think that we should think that's a safe harbor. I think we should be on guard. And I also think there is a little bit of a sense that when interest rates were zero and everything worked, it seemed like the playing field was level. But as interest rates go up 5%, the gap between the winners and the losers is going to widen. I'm talking about financial firms. And as that gap widens, I think the marketplace is going to pay attention to who their counterparty is. So, you know, risk is on at 5% interest rates. When interest rates were zero, risk was lower. So I think that is, you know, there's going to have to be some watchdogging going on. And also, too, I think the credit rating agencies feel a little stung. Remember, Signature and Silicon Valley were both investment grade rated when they failed. That's a big moment in the rating agency world. So I think that you're going to see the bar be higher, for example, even for rating agencies.